I personally believe that this beneficent epoch that we enjoyed, this 4-decade epoch, came to an end in 2022. And I personally believe that there will be a lag in psychology from a psychology of boom to a psychology of caution. By the way, I'm not calling for the Greater Depression. I'm not calling for the end of the US dollar. I'm not doing all that doom and gloom stuff. All I'm saying is that there is going to be a reckoning as a consequence of the obligation that our society favors. And that reckoning, I think, almost necessarily results in the continued and accelerated depreciation of the purchasing power of the US dollar, and increasingly, too, a recognition of the benefits of gold.
For 4 decades, the United States has enjoyed a thriving bull market. This began in the early 1980s when central banks, led by the U.S. Federal Reserve, unleashed draconian quantitative tightening measures to bring down double-digit inflation. The high interest rate environment led to over 40 years of deflation and a booming bonds market that experts believe ended in 2022. However, this 40-year bull run created a mythology around bond investing, misleading even academic economists and other experts to declare government bonds as safe assets that delivered a risk-free interest rate. They also claimed that bonds offered diversification against risky equities, an argument that provided the rationale for the hallowed 60-40 portfolio split between equities and bonds. However, these beliefs and the recency bias that the US economy will always be buoyant and will never be plagued by another severe economic decline have been consistently tested in recent years. Since the COVID-19 recession in 2020, experts have been warning that the 40-year bull market is over and the US economy is heading for some very uncertain times. Legendary investor and renowned metals analyst Rick Rule takes these warnings a step further in a recent interview with the Lead Lag Report hosted by Michael Gade, noting that the world is about to realize the true importance of gold and the rest of the natural resource sector. In his interview, Rick notes that the world has almost completely neglected and significantly underinvested in the resource sector, particularly due to the green energy drive. However, Rick warns that this mistake is about to cause a massive shortage in the supply of these resources. Naturally, this will lead to a supply shortfall and higher prices in the entire resource sector. Before that happens, Rick warns that the coming sovereign crisis will cause a massive increase in gold prices. He predicts that gold will hit at least $8,000 to $10,000 in no distant future, as the world realizes what's happening. We will present clips from Rick Rule's interview. But before we do, please take a little time to like this video, subscribe to the channel, and turn on the notifications bell for more videos like this. We appreciate the support and hope you enjoy the video.
Which commodity do you think benefits the most from the Fed easing?
I think in the near term, and I define the near term as a year, gold. Gold, in my experience, has done particularly well when people are concerned about the maintenance of purchasing power in their domestic currency. This Fed decision is really interesting. We're told we have a great economy, and the equities market would suggest we have a great economy. If we have a great economy, why do we need a 50 basis point rate cut? That's of interest to me. A broader topic, I think, Michael, around gold is the fact that if you believe, as I do, that the gold price does well when people are concerned about the maintenance of purchasing power in fiat-denominated instruments, let's do a little bit of arithmetic. The government would have you believe that inflation, their measure of the deterioration of the purchasing power of the US dollar, according to the CPI, is cruising along at 2.6. If you believe that, earning 4.2, 4.3, or now 4 in the U.S. 10-year Treasury isn't a bad deal. You get paid 4% real yield in a currency depreciating by 2.6% a year. You get a positive real yield. I don't believe those numbers, Michael. I do a thought exercise every year, and I have for 6 years, around the pricing of the basket of goods and services that I consume in my life. The government, when it's inconvenient, doesn't include food or fuel. Unlike you, Michael, I'm not on a fast. So the price of food is of some import to me. Importantly, the government number in the CPI doesn't include the cost of government itself, while tax is usually the largest component of every household budget, every working family in the United States. If you believe, as I do, that the deterioration of the purchasing power of the US dollar is more like 7.5 than it is to 2.5, then the fact that you're getting paid 4% on your 10-year Treasury, on your deposit products, in a currency that's depreciating by 7.5% means that the money that you're saving is losing you 3.5% a year in purchasing power. There is nothing in the world that would cause me as much concern about the deterioration of my purchasing power as that simple piece of math. Cutting the reference rate, cutting the Fed rate, cuts the yields on other savings deposits, while at the same time likely increasing the deterioration of the currency in real terms. And I would suggest that the beneficiary of this, once that arithmetic comes to be felt in the market, will be first in the gold market. I came into the business in the decade of the 70s, and the circumstance that confronts us now confronted us in 1968 when I was a little too young to understand it. But it was pretty clear after having fought the war in Vietnam and the war on poverty that we had more obligations as a society than we could service. It became fairly obvious, too, that we couldn't raise tax to cover the net present value of our obligations. So what we did in the period 1970 to 1981 is that we reduced the purchasing power of the dollar through inflation by over 80% in 11 short years. The consequence of that is that the gold price, of course, went from a price-controlled $35 an ounce, to a price in excess of $800 per ounce. What's germane to the question is that the writing was on the wall around inflation beginning in 1968, but it didn't become a matter of popular concern until 1972 or 1973. If you dial back to that circumstance, if you dial back to those days, we had experienced very, very, very buoyant economic conditions from the end of World War II, say 1946, all the way through 1968. The Nifty 50 is an example, the wonderful growth of American hegemony around the world, the strength of the US dollar, and people were conditioned to be optimistic. I would suggest that we have lived through an even longer and even more beneficent circumstance from 1982 to 2022.
For at least another decade, Rick predicts a weaker dollar, more weakness in stock market indices like the S&P 500, further signs of weakness in the US bond market, and a generally gloomy economy. Experts' predictions for other developed economies, starting with the Chinese economy, are even more dire. Many analysts believe the fiat debt-based system is on its last leg and heading for a collapse. They predict that this collapse will usher in a new financial system, which will be backed by tangible assets like gold and silver, not easily inflated fiat currencies like the US dollar. According to Rick, investors are gradually losing confidence in the US Treasury market, but it is not happening on the scale it should be. When the maximum realization hits the public, and everyone realizes that the financial system is rigged to fail, Rick predicts that the demand for precious metals, beginning with gold and silver, will quadruple, and so will prices. Rick has always been particularly bullish on silver, which he often describes as a most hated asset, but the opportunity of a century for investors. Let's get back to the interview.
I am not buying silver bullion. I have a fairly large position in gold bullion. By the way, I'm stupid to do that. I'm the largest shareholder of Sprott Inc. And if the gold market and the silver market run, in theory, the most important brand name for retail investors in gold in North America is Sprott, I will do well. But I own gold bullion because it helps me sleep nights. And at age 71, that's a real benefit. I do own silver stocks. And I own silver stocks because towards the middle of a gold bull market, through the end of the gold bull market, historically, there is no asset class that performs as well to the upside as the silver stocks. The population of legitimate silver stocks is very small, and their combined market capitalizations are very small. 4 times before in my career, the precious metals narrative has been such that the generalist investors go first into the gold equities, but later into the silver equities, and the combined market capitalizations of the silver equities, we'll call that the silver silo, is so small that it can't handle the influx of capital that comes in. And the results can be very dramatic, Michael. I remember in the decade of the 70s, when I was too young and too dumb to play well, Coeur d'Alene Mines went from 10 cents a share to $65. In the latter part of the decade of the 80s, before that wonderful bull market that happened 91 to 96, I was able to finance two small silver companies. One, Pan American Silver at 50 cents. The other, Silver Standard at 72 cents. 6 or 7 years later, both of those stocks had crested through $40. So when I say that in a silver bull market, the asset class that performs most dramatically to the upside is silver stocks, that is an indication. I was vocally bullish about silver stocks in December of last year and January of this year, for the simple reason that there was so much hate concerning them on social media. I determined that from my own viewpoint, almost everybody who wanted to sell had sold, because there was no love, there was only hate. The consequence of that is that that subset of silver stocks has done very, very well, up about 50, 60% in the first, 7-8 months of 2024. In direct answer to the question, about 2.5% of my total portfolio was invested in silver equities. That has become about 3.5% of my portfolio, not because I've added more money to it, but simply because the prices of the small silver stocks has outperformed most other asset classes. In most industrial commodities, humankind has been underinvesting in productive capacity around those commodities for a very long time, so that even current levels of demand will, in the 5, 6, or 7 year time frame, exhaust our ability to produce them. We continue to underinvest in such commodities as copper, nickel, platinum group metals, nutrient materials like potash and phosphate, and oil and gas. So that if the pace of investment, the pace of productive capabilities doesn't increase, normal demand will overwhelm supply. The only reason that that wouldn't take place is if we had a synchronized global recession or depression. If we don't have a synchronized global recession or depression without the renewed vigor of Chinese expansion, but rather simply demographic trends, demand, even if it just held steady at today's rate, begins to overwhelm our ability to supply in a period as short as 5 years.
Rick Rule's investment philosophy around precious metals, particularly gold and silver, emphasizes a long-term approach, especially during times of uncertainty. In his analysis, Rule highlights that while the economy has shown resilience, underlying factors like skyrocketing government debt and persistent uncertainty suggest that traditional financial systems may face significant challenges. His stance is rooted in the historical role of gold and silver as stores of value, particularly during periods of market volatility and inflationary pressures. Rule's recommendation to return to hard assets is based on the idea that precious metals have proven their value over centuries, unlike fiat currencies that are subject to policy-driven devaluation. He encourages investors to stick with their strategies, even when market conditions fluctuate, as these assets tend to maintain intrinsic value over the long haul, providing a hedge against economic instability. What are your thoughts on Rick Rule's interview and his analysis of the current economic situation and market conditions? Please drop your comments and observations in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.